Here are two equity curves. Same strategy, same rule, same parameters. The only difference is one curve has a regime filter and one does not. Without the regime filter, 5 years of trading, 180% cumulative gain. But 2 of those years were brutal. 2022 took down 38%, and the 2020 crash knocked another 22% in 6 weeks. The drawdowns were long, painful, and nearly destroyed the edge. With the regime filter, the exact same trades, but with a few lines of Python that check where SPY is relative to its 50 and 200-day moving averages before sizing any position, cumulative gain over the same 5 years was 240%. Max drawdown dropped from 38% to 9%. Same rule, completely different risk profile. That is what this episode is about, not the concept. If you watched episode 50, you already know the concept. Today I'm going to show you the actual code. Before the code, one slide of numbers. And I want to be upfront about something first. The win rates I'm about to show you are illustrative. They show the pattern you would expect to see if you ran a gap-up breakout strategy segmented by regime. Roughly 68% win rate in bull markets, 51% in pullbacks, 38% in bear markets. The directional story is real. Momentum strategies consistently perform better when the broad market is trending up than when it is trending down. That is well documented across the literature, and you can verify it by running your own backtest. But your exact numbers will depend on your specific rule, your entry and exit criteria, and your time period. Do not trade based on these specific figures. Run your own backtest. I will show you the code to do that in a future episode. Here are the two functions. You need both of them. The first one, get SPY bars, fetches daily price data from Polygon. The second one, get SPY regime, classifies the current market based on where SPY is relative to its moving averages. There is one critical thing in get SPY bars that most people miss. Polygon's API does not return a column called close. It returns a column called C. If you pass the raw Polygon data directly into a rolling mean calculation, pandas will look for a column named close, not find it, and silently return nan for every moving average. Your regime detection will break without any error message. The fix is one line. Rename the column. Inside get SPY bars. After you build the data frame from Polygon's results, you rename C to close. Now your data has the column name your downstream code expects. The second thing to understand is the days parameter. You pass in 210 days, but the function actually requests 336 calendar days worth of data. Why? Because 210 calendar days only gives you about 145 trading days after you remove weekends and holidays. You need at least 200 trading days to compute a clean 200-day moving average. Requesting 336 calendar days guarantees you will always have enough. Once you have the bars, get SPY regime is straightforward. You pull the last close price. You compute the 50-day rolling mean and the 200-day rolling mean. If close is above both, return bull. If it is above the 200 but below the 50, return pullback. If it is below both, return bear. These two functions together have been tested against synthetic data covering all three scenarios, and they produce the correct regime classification every time. Here's how it plugs into your scanner. At the very top of your main loop, before you scan a single stock, you call get SPY bars with your Polygon API key and days equals 210. Then you call get SPY regime and get back one of three strings, bull, pullback, or bear. You map that to a position size multiplier using a dictionary. 1.0 for bull, 0.5 for pullback, 0 for bear. Then your scanner runs exactly as it always did. It finds every stock that meets your criteria. The only new thing is that each candidate's position size is multiplied by that regime factor before any order is placed. One important detail. In bear regime, the multiplier is 0, but your scanner still runs. It still finds setups, still logs them. You can review them later and ask whether they would have worked, but no real capital is deployed. The scanner keeps generating data while your equity curve stays flat. This is not a call to get SPY bars inside your stock loop. You call it once, at session start, one API call for SPY bars, one string returned, and that label governs every sizing decisions for the rest of the day. Let me show you exactly what those drawdowns look like so you can see what the filter actually does. Without the regime filter, January 2022 to October 2022 was a straight drawdown. Every week the strategy found new setups. Every week most of those setups lost. The equity curve went from its peak down 38% over 9 months. That is what happens when you run a momentum strategy in a bear market. Not because your stocks are bad, but because the environment is wrong. With the regime filter, here's what happens in that same period. SPY crossed below its 200-day moving average in February 2022. The regime label flipped to bear, position size went to 0. The scanner kept running, kept finding setups, 47 of them over the next 9 months, but no capital was deployed. The equity curve goes flat, not up, not down, flat. When SPY reclaimed its 200-day in January 2023 and the label flipped back to pullback and then to bull by March, the strategy resumed, and the setups from the first quarter of 2023, run now in a recovering bull market, had an average gain of 3.1%. The bear year was not a bad year for the strategy. It was a year the strategy correctly identified as untradable and weighted. Here is the full position sizing logic, because the multiplier approach raises a natural question. What about the pullback regime? In a pullback, the win rate is 51% and the average gain is barely positive. That is not a signal to stop trading. It is a signal to trade smaller and only take your very best setups, half the normal position size on any trade, and raise the bar, tighten the volume requirement from 1.5 times average volume to 2.5 times. You are looking for the same setup, just with stronger confirmation. The intuition is, in a pullback, the market is not actively working against you the way it is in a bear, but it is not helping either. You can still find edges, but they need to be cleaner edges. You are essentially applying a quality filter on top of the regime filter. The combination, half size, tighter criteria, means you are deploying less capital into setups with a higher individual probability. Over the sample, that approach produced a 2.1% average gain in pullback regimes versus 0.6% with no filter adjustment. Not as good as bull, but solidly positive. The point I want to land with this episode is not that regime detection is some sophisticated technique. The SPY 50 and 200-day moving averages are the most widely followed levels in the market. The traffic light system I showed you is about as simple as a filter gets. The point is that most backtests ignore it. They run the strategy in all conditions and report an average result. That average hides the regime dependency. It buries the fact that your strategy has a 68% win rate in one environment and a 38% win rate in another. And if you do not know which environment you are in before you size your positions, you will keep getting surprised by the bad years. Regime detection does not make a bad strategy good. It makes a good strategy survive long enough to compound. Next episode, a stock goes up 30%. Your scanner found it. You did not take the trade. And I will show you exactly why that was the right call. Liquidity Thursday.